We have crossed the event horizon, a point where the silver market can no longer return to normal behavior because suppression mechanisms have finally failed under extreme pressure. For years, the warning signs were dismissed, yet the artificial cap on silver prices could only hold as long as liquidity and trust remained intact. That trust collapsed when silver surged violently, a move that does not represent a rally but a forced liquidation event inside the financial system. A 10% daily move in a major commodity signals distress, meaning someone large was forced to exit at any price to survive. This is how markets break, not slowly, but suddenly, when leverage collides with thin liquidity and automated margin enforcement. During low liquidity periods, even modest force buying can cause prices to gap violently because there are no sellers willing to absorb demand. What we witnessed was not enthusiasm, but panic, as algorithms consumed the order book without regard for valuation or technical levels. A vertical chart does not reflect optimism, it reflects structural failure, where price discovery accelerates beyond human control. This event marks the transition from theoretical short squeeze risk into a systemic reality impacting institutions, not retail traders. When large short positions implode, clearing systems take over and force immediate closure regardless of market consequences. This process removes negotiation entirely, replacing price discovery with compulsory buying at escalating levels. The result is a sudden repricing shock that exposes years of accumulated leverage and hidden fragility. Such moves reveal where power actually resides in the market, and it is no longer with price suppressors. Silver's surge is therefore not isolated, but a signal that the broader monetary framework is under strain. Investors are reacting not to headlines, but to loss of confidence in paper claims and financial intermediaries. When confidence breaks, capital seeks tangible assets that cannot be printed or defaulted upon. This is why silver reacts faster than most assets once suppression fails. The violence of the move reflects how long energy was compressed beneath the surface. Markets do not warn politely before breaking, they snap when pressure exceeds tolerance. What follows such a snap is not stabilization, but a chaotic phase of accelerated price discovery. As silver reprices violently, attention must shift to gold. The monetary anchor that confirms this move is not speculation, but systemic repricing. Gold breaking historic thresholds validates silver's breakout, proving this is a currency event rather than a commodity anomaly. When gold holds extreme levels, silver mathematically cannot remain suppressed without breaking the ratio structure. The gold-to-silver ratio compresses rapidly when confidence in fiat currencies erodes. At current gold levels, silver remains fundamentally undervalued despite its dramatic surge. This imbalance triggers algorithmic catch-up trades that accelerate silver's ascent. Algorithms do not trade emotion, they trade mathematical divergence. As gold reaches price discovery, silver becomes the leveraged expression of monetary stress. This is why silver moves faster, sharper, and with more violence than gold. The catch-up phase creates momentum that feeds on itself. Each incremental move attracts new buyers who were previously waiting. What appears to be irrational behavior is actually delayed rationality expressing itself all at once. Markets punish complacency, and silver punished those who assumed suppression was permanent. This phase is not driven by headlines but by structural recalibration. Capital is repositioning away from promises toward assets with no counterparty risk. Silver benefits uniquely because it straddles both monetary and industrial demand. This dual role tightens supply faster than most investors anticipate. As confidence fades, the revaluation accelerates. The speed of the move reflects years of distortion unwinding simultaneously. This is how suppressed markets behave once control is lost. Now attention shifts to the weekend, when markets are closed but fear continues to compound inside fragile financial structures. A frozen price does not mean stability, it means pressure is building with no release valve. While screens are static, risk managers are recalculating exposure under worst-case scenarios. The weekend creates psychological stress for anyone holding leveraged or paper silver positions. Holders of physical metal sleep differently than holders of contracts. When exchanges close during a volatility spike, uncertainty multiplies. Traders are forced to imagine outcomes without the ability to react. This anticipation drives capital toward physical markets before trading even resumes. Physical dealers respond by pulling inventory and suspending automatic pricing systems. When sellers cannot price metal, the market has already failed. Premiums detach from spot prices during these moments of disorder. The street price becomes the real price, not the number on a frozen screen. This divergence defines the early stages of a currency crisis. If goods cannot be purchased at the official price, the currency is no longer functional. Silver exposes this failure faster than most assets. The weekend gap creates fear-driven demand that stacks orders for the reopen. These queued orders compress volatility into the opening minutes. When the market reopens, price does not walk, it jumps. This is how gaps form, not from news, but from fear accumulation. The longer the market remains closed, the more violent the reopening becomes. As markets prepare to reopen, attention turns to circuit breakers designed to slow price discovery when volatility exceeds acceptable thresholds. These mechanisms do not prevent losses, they merely delay recognition of imbalance. When silver approaches daily limit levels, trading halts create trapped participants. Short sellers experience maximum psychological stress when exits are unavailable. A halted market is not neutral, it is directional pressure locked in place. Each halt concentrates future buying into the next reopening window. This dynamic transforms volatility into a staircase rather than a smooth curve. Locked markets communicate scarcity louder than any headline. The inability to transact confirms demand has exceeded system capacity. For holders, halts represent validation, not danger. Clearing rules amplify momentum once limits expand. When trading resumes, price discovery accelerates violently. Intraday ranges expand beyond historical norms. Leverage becomes lethal in these environments. Ownership replaces speculation as the dominant strategy. This phase rewards patience and punishes speed. The market transitions from trading logic to survival logic. Price levels lose meaning during vertical repricing. Only flow matters when supply vanishes. This is the anatomy of a melt-up under structural stress. Beyond financial markets, the silver shock immediately transmits into the industrial supply chain. Industrial buyers do not speculate, they secure material or production stops. A sudden price surge signals potential unavailability, not just higher costs. When volatility spikes, suppliers hesitate to commit inventory at fixed prices. Contracts with force majeure clauses begin to fracture under extreme moves. This pushes manufacturers directly into the spot market. Industrial demand becomes price insensitive when supply continuity is threatened. Factories compete with investors for the same finite metal. This competition accelerates shortages far faster than financial models predict. Once industrial hoarding begins, metal rarely returns to public circulation. Silver consumed in production is effectively removed for decades. This creates a one-way supply drain during periods of stress. The market shifts from abundance assumptions to scarcity reality. Price must rise high enough to ration demand. This rationing process is chaotic and non-linear. Industrial panic buying magnifies financial volatility. Each supply disruption feeds back into price acceleration. The feedback loop tightens until demand destruction occurs. This stage defines the difference between a rally and a crisis. Silver is now entering that crisis phase. As stress intensifies, attention shifts to clearinghouses, the final backstop holding the futures market together. Clearing systems are designed for volatility, but not for sustained vertical repricing. When margin requirements explode, weaker participants fail immediately. One default forces losses onto the clearing pool shared by surviving members. This transforms individual failure into systemic contagion. Trust between financial institutions erodes rapidly under these conditions. Liquidity disappears not because of regulation, but fear. Banks stop extending credit when counterparties become uncertain. This freeze spreads beyond metals into bonds and funding markets. Silver becomes the stress fracture, revealing deeper structural damage. Central banks face an impossible dilemma once contagion begins. Intervention requires liquidity expansion, which weakens currency credibility. Currency debasement reinforces demand for hard assets. Attempts to stabilize the system paradoxically intensify the silver squeeze. This reflexive loop traps policymakers. The more aggressively they act, the faster metals reprice. Financial repression loses effectiveness during physical shortages. Confidence cannot be printed once broken. The market senses this contradiction instantly. Silver responds by accelerating beyond administrative control. As institutions struggle, public attention finally turns towards silver. Retail investors respond to movement, not valuation. A single violent candle awakens years of apathy. Search activity and brokerage logins surge simultaneously. Retail capital enters without price sensitivity. This influx overwhelms already fragile liquidity. Professionals attempt to exit as the public attempts to enter. The collision amplifies gaps and halts. Media narratives lag price action and misdiagnose causes. Accusations of speculation miss the underlying shortage. Public participation accelerates supply exhaustion. Coin shops and dealers experience immediate depletion. Premiums detach further from futures prices. The feedback loop tightens between panic and scarcity. This transition marks the shift from shortage to mania. Mania is chaotic but highly profitable for prepared holders. Volatility becomes the price of admission. Emotional discipline separates winners from casualties. The temptation to exit early becomes intense. Long-term conviction becomes the decisive advantage. The market now stands at a historic inflection point. Suppression has ended and true price discovery has begun. Volatility will remain extreme as the system adapts. Daily swings become irrelevant within a secular repricing. What matters is ownership during monetary transition. Silver represents both insurance and opportunity. The path forward will be emotionally demanding. Preparation replaces prediction in chaotic markets. Security, patience, and clarity become essential. Exit strategies must be defined before euphoria peaks. Wealth transfer occurs quietly before public consensus forms. Those positioned early benefit disproportionately. The metal does not care about narratives. Price responds only to flow and scarcity. History will record this phase as inevitable. Future explanations will arrive after the fact. For now, discipline is the only edge. Silver has broken free from decades of distortion. The repricing process is irreversible. The system changed, and there is no return.